Hello, ladies and gentlemen, and I'm excited to be speaking to you today. My name is Fran Green, and I am the National Sales Manager here at More to Life. Now, my session today is all going to be about affordability and the importance of affordability in the lifetime mortgage market as it stands today. So we will be moving on to our slides, and we'll be talking first and foremost about today's learning objectives. So our learning objectives for today are going to be threefold. We're firstly going to look at why an affordability assessment is so important in the lifetime market. Now, again, even in general practice, we know sometimes historically people haven't actually considered affordability something that they needed to do in the traditional lifetime space because there isn't, with some products, an incumbents to make a payment. Therefore, affordability would not be actually relevant. But then the regulator and the council have said something to say about that more recently. So again, we're going to look at, as the second learning objective, that piece about what does a regulator expect of us? What does our council, if we are council members, expect of us also? And then we're also going to meld into this as well, a look and a view of some of the modern products that we've got. Those affordability-based products where actually you can get even greater customer outcomes if there is an ability and a willingness to make a payment. So first and foremost, why is it important? So we often hear this phrase, it's for the benefit of the estate. Anybody want to tell me what that means in real terms? More left behind. So when they've got their progeny that they're going to leave their value of their estate, there'll be more of it to gift onwards. Now, a lot of advisors will say to me, though, my customers don't have anybody they want to gift it to, or they don't have anybody to gift it to. Or alternatively, actually, once they've got to that stage where they're accepting that they're going to have a lifetime mortgage, they're at peace with not leaving anything behind. But we do know that within the consumer duty, it does call us to think about offsetting foreseeable harm. And we are seeing that a lot more people at a younger age are taking out this borrowing, as Rachel referred to earlier. And, you know, people's circumstances change, life happens. So for me, one of the equally, if not more important points of retaining as much value within their asset, their home, for the benefit of their estate is actually for the benefit of themselves. Because if you actually control the roll-up on a lifetime mortgage, you are leaving much more equity within your asset that can actually be used for your future borrowing needs. You know, somebody at the age of 50 can feel fabulous. Somebody at the age of 60 can be feeling super. Somebody at 70, maybe not so much. Nobody knows what the future holds. So actually, if they do have changing circumstances and the need to tap into their asset for a future need, such as care in the home and modifying their home, or that daughter who is married to a very wealthy gentleman who was never going to need their help finds herself in a broken marriage and needing support through a divorce, actually protecting, as I say, that roll up to protect as much equity within the asset is for their benefit. And again, coming back to consumer duty and offsetting their foreseeable harm. And with these modern products where you've got maybe a customer with an ability and a willingness to make payments over a certain period of time, you can also attract lower interest rates. So the impact of making payments plus actually having a lower interest rate would benefit both of the above. Just going to take you through some visual representations of that. So this is us at More to Life. We are a multi-funded proposition. We have propositions that are available for those that have got the most modest borrowing needs right the way up to the maximum releases. Now, one of our flagship products is our Flexi Choice product. And you see this here being used for somebody who's actually wants the match release, but at the best rates. And it's a 55-year-old who wants to release just over £40,000. They take that out at a rate of 6.99, and over their anticipated term of 27 years, they will have that payback and that roll up, as you can see there, still leaving about 100 and something in their equity within their asset based on that projection of house improvement and price growth. Now look at this scenario, and this is where somebody has got a willingness and ability to make those payments and can do so with a modest amount, potentially of £190 a month. Because of that, they attract a lower interest rate that you can see there at 6.56. And the combination of the lower interest rate plus that making those payments you will see there makes them a saving of over £100,000. It's probably about £125,000 that they're looking to save there. Now, we think about our Flexi Interest Reward and somebody actually who can maximise their affordability. And you see that in this next scenario. You have got that somebody who leaves it to the roll-up, that's that green line as you saw in that first graph. versus somebody making a payment of £338 a month, if that's affordable and sustainable to them, can actually not only reduce their roll-up, but actually completely clear their debt after 16 years and 5 months. And again, that attracts an even lower interest rate. And to explain that a little bit further in regards to our Flexi Interest Reward product, it is a fully flexible feature of our Flexi Choice plan. Now, there are full presentations and training sessions on this product in its own right, but to summarise some of the key points of it, it is a lifetime mortgage from day one. So it doesn't travel with the threat to repossession. It does have a rate that is fixed for life. It comes with the other protections of a lifetime mortgage, such as a no negative equity guarantee too. Now, when it comes to the affordability assessment, there's a lot of mortgage advisors in the room, different to other sessions. So what is the benchmark for people to use actually to say within the lending scenario that something's affordable? Is it what they can actually afford, or is it something else? Plus usually a stress test. So I was up to and into retirement lending for years, and I got very tired of telling brokers that their customers couldn't afford borrowing, that the payments of which were half that they'd serviced for the last 10 years because the computer said no. Now, these payment-based products don't come with those challenges. You don't have to provide income verification to us as a lender. You can make that genuine assessment as to whether these are sustainable throughout whatever payment term that you are suggesting. Now, what these products do come, I summarise it in saying it's 4 superpowers. So the first and foremost, and if you are familiar with the interest reward type products in the market, that makes this one different, is it actually isn't related to servicing any interest. In fairness, actually, the very first case that we did, I will talk about in a second, came at a monthly commitment that was way below the 25% interest served starting point that many other products do. So we will give you will work out what that customer's net disposable income is, and then we will give you potentially several different payment points that will travel with a different discount. So you can pick something that really suits their budget. Now, again, unlike other plans in the market where they might say you have to set a term of 5, 10, 15 years or, those kind of options available, this product with some age limitations actually comes with a variable term. So if you've got a customer that, say, is at age 60 and wants to stop making payments aligned to their state retirement age at 67, and they want a 7-year term that suits their circumstances, instead of you having to overcommit them to 10 years or undershoot their payment potential to a 5-year term, you can actually pick that 7-year term. So that's full personalisation within their budget and their circumstances. Now, these then bring me to the absolute favourite features of this product, which are absolutely unique. So with customers with other payment plans out there, in various circumstances, they will risk losing their discount. With this particular product, if you have made partially way through your discount, then you are actually able to retain some of that discount. And these discounts, once awarded, once you've achieved that lifelong lock of that discount, are awarded for the life of the loan. And if a customer is using a maximising their affordability and making overpayments, again, T's and C's apply there. So please do come to the more detailed sessions about how that works. But actually, they can lock in that discount even if they have to stop making payments partially through their term. So if they've been able to make 50% of their commitment, for example, they will retain 50% of that discount for the life of the loan. So there's lots of major benefits to this. Now, you will see, as I mentioned with our Flexi Interest Reward product before, it is very budget friendly. So once you have committed that a customer, you've identified that net disposable income, you can see what different options. And in this scenario here, payments from £51 up to, I think it's £143. And looking again at how that compares across the piece, you can see here we've got a number of options. You've got our Flexi Choice, where you're making no payments. The Flexi Choice with making payments, that saves you over £44,000. And then the next one, and that's just with a £70 a month commitment. And then that next option there, as you can see, it's where they actually commit to paying that £70. You can see that brings that interest rate down, and therefore the saving that they're making is increased to £57,000. So for just £70 a month, that is not an insignificant saving. And then we bring you to the other extreme where somebody can actually maximise their affordability. That's £338 there, brings the rate down to 6.52 and increases that overall saving basis, not making any payments to committing to making a payment in the maximum affordability space of a £200,000 saving. So these products, if they are appropriate for the customer's needs, that they are actually the ones that, will get you the best customer outcome. Now, coming on to actually making the assessment. Now, again, a lot of mortgage advisors in this room, so this will be a bit of this is not unfamiliar to you. But I think it's still worth shouting out a couple of points on here. So I often hear advisors talk about, somebody, they're expecting an inheritance. We have a product at More to Life, our Maxi Zero ERC product, and that's a product that's designed to actually be paid off earlier. And actually one of the top reasons given for what they think the reason why they'll be paying it off early is because they are expecting an inheritance. These things don't tend to happen as we expect them to. So again, those future windfalls that we might expecting really shouldn't be taken into account from an income point of view, because unless you can count on it, it can't be there. But what we do need to take into account, which you guys again in the mortgage world will know, is any known negative changes through any payment terms. So if somebody's going to lose a source of income, we need to factor that in. And this is where I think these products are so much more fairer than the standard products that we're used to in the standard mortgage market. Because most of those lenders will base, or the ability to be able to borrow will be based on ONS statistics. Every household smokes. Not so. Every household drinks. Maybe. All of those different assumptions that are generic. Now, you guys have a great opportunity here when you're looking at the expenditure side of here to make obviously realistic net disposable income assessments, because you're going to be able to sit and deal with that person, not as a generic person, but as an individual in terms of what's important to them and what's not. And it is that, I do joke, but it's not a joke, that my husband would rather not eat than cancel his Sky Sports subscription. For me, it's my Netflix, little stories that I like to take my head out of the real world. And there are those things, as I say, but you get to then make what is the true net disposable, not what somebody thinks it should be based on averages and then stress test and taking a haircut off. And then there you can make those genuine recommendations to the customer. And Alistair mentioned earlier about bank statements. Again, I always talk about bank statements being our friends. They are a source of the truth and can make an income and affordability assessment really accurate. It does also give us those opportunities to spot vulnerabilities, and something else that the Financial Conduct Authority wants us to do, which is actually to increase our customers' financial resilience. Again, people remember things differently. I tell a very true story about myself sitting down to do a budget to save for a significant thing I wanted to buy, and realised I'd been paying cat insurance for a cat that had been dead 10 years. These are things that we can actually help our customers with if you can do that kind of assessment. So coming on then to the FCA's expectations now, these are severalfold, and these were taken because there hasn't been one set rules or guidance, but they have published a number of different consultation papers to the market to say these are the things we expect, and they do expect us to make affordability assessments when we are looking at people's individuals' income and, their personal circumstances. They 100% expect us, if there is an ability and a willingness to do so, to recommend that people make payments, be that on a voluntary basis or on a committed or a contractual basis, depending on what's right for their circumstances. Now, I am not of the camp that says that everybody with income and affordability has to have an income-based product. Not everything is for everybody. I talk about my circumstance. I'm so glad you're all sitting down when I tell you actually I'm 50. Obviously, I look a lot younger than that. But I am a single income household with 2 adult dependents. I have got a good earning capacity and I'm comparatively speaking rather young. And if I went to a mortgage advisor, they would most likely say to me, we'll do you a 5-year fixed rate, get you over that affordability hurdle. We'll do you the longest term possible. We'll kick the can down the road and deal with repaying your debt later. That is no sustainable solution to my financial objectives of being free for a mortgage payment and being able to remain myself and my family in our home for the rest of our lives. You have got the alternative of Rio, where we wouldn't have the cliff edge of having to deal with the do I downsize or not. Do I want to make a mortgage payment and have my home at risk of repossession till the day I die? No, I do not. So, I could be that candidate that on paper could go down the TO or Rio route, but actually for a whole host of reasons I don't want to. And what I would say there from my regulatory experience and what they would say is what's really important there is the why. And keep asking the question why until you can't ask it anymore, and capture that on your suitability letter. So you're making safe recommendations that you can obviously back up should be asked to. But equally, this is all about tailoring advice to customers' individual circumstances. If they do have an ability and a willingness to make those payments and they don't want to, that isn't enough of a reason for the regulator. Again, keep capturing the why until there is no more why to capture as to why they don't want to make those payments, to make your advice really robust in that space. Because it is all about tailoring things to customers' individual circumstances, needs and wants. They also would like us to monitor those outcomes, to do those regular reviews, to make sure the advice we give actually remains the right advice as their circumstances change, and also to recommend the products that are suitable to their circumstances. So again, it's a no-brainer. If you've got somebody who has got income that can make payments, they take those type of products if it's appropriate. But equally, if something's not appropriate to that cluster's circumstances, that we don't recommend it just because we think somebody else is telling us we should do. Now, why are these things important? We've mentioned them in buckets already. It's about controlling the roll-up for the estate. It is about that fair treatment of vulnerable customers, because somebody in the circumstance where they could, sleepwalk their way into a rolled-up mortgage and a lot of debt, this is helping us protect those people. It also means we are adhering to the regulatory guidance that we're giving. Anybody who was in the mortgage market pre-2004 knows what happened to those people who didn't get on board with the regulatory changes post that. They're not around here anymore to be able to tell the tale. So it is something I would say embrace what the regulators are saying, because this is something they're very, very serious about. And it is also to support that financial resilience I mentioned earlier. I didn't mention it in the earlier slide where it comes to income and affordability, but there'll be things in there that they're spending that maybe they don't need to, or that they shouldn't. This is on demand, so the advisor that told me the story will know I'm talking about him. In terms of a customer, he sat down with bank statements to work out that they actually had a net disposable income position. They were paying £200 a month in charitable donations. So again, just being of a certain nature and agreeable, actually, and that was something that he was able to address with them. And I'm absolutely saying that nobody should be charitable, but it's obviously got to be within a customer's means. And they're the kind of things that we can help when we're looking at the income and affordability piece for these customers, as well as making sure they end up with the right product for their circumstances. 45% of advisors have not used that field to be able to actually identify these products. Now, if you're not filling in that box, you're essentially telling the computer they have no money to afford to be able to make any payments. Therefore, you will not see these products and be able to demonstrate to that customer what a great customer outcome it could be. And when we bring that back to the 1 in 4 people, actually just over 1 in 4 people who have gone on to make payments from that cohort of borrowers we talked about before, that's 1 in 4 people of nearly half the market aren't being given the opportunity to consider those better products and not getting the best customer outcome that they could. And I'm going to bring this to life in terms of, this is a gentleman that actually wrote our first Flexi Interest Reward. He's a great advisor. 80% of his customers now go on to make a contribution, when the majority of them actually started out with preconception that they actually didn't want to make those payments. Now, he does a great job. He does that income and affordability assessment. He's got a general practice background. So those guys here that are general practice, you will be already set up to do this. He will talk about all the different modern features and the availability, and he will identify their net disposable income. And what he can do with that is he can look at that in the extreme with the customer and says, look, if you had no pennies left at the end of the month and you put everything into your expenditure and your mortgage, this is what that debt would look like. How does that feel? And then he's able to ski downhill to be able to have a look at those different options within those different budgets and their desires and wants of how much money they want to spend and how much they want to retain, what I call fun money. And actually then he shows it all the way down so they can then pick a payment point that's comfortable for them. So as I say, 80% of those customers actually then go on to make regular payments. So again, with the right kind of guidance and advice and demonstration of the benefits of making payments, they get into a much better place. Now, I didn't mention it there in terms of, some people say, do they have to make a big contribution to actually make a difference on rates? Now, actually, the first case he wrote, it was just £55 on 6p, actually, to be exact. That was the commitment that the customer was going to make over a 10-year period. Now, that customer, as an alternative, as I say, they could have made no payments and got a higher rate, but they didn't, and they made a significant saving over that period of time. So even a little can make a big difference, and that was well below the 25% interest served entry level compared to many other products out in the market. Now, who here is an Equity Release Council member? about half the room. For anybody that isn't, I would well recommend it. There is a great session, and if you go through the Air Masterclass history and you talk about marketing, there's a gentleman called John Dunkley who does some great sessions, and he talks about wearing a badge. Being part of the council actually gives you a great deal of credibility with those customers. But those people who are council members, again, you should know then there are 3 areas. They have their overarching principles, they have their customer outcomes, and they have their specific rules. And you see there, it's all about they expect us to deliver good customer outcomes, whatever that might be, based on the customer's individual circumstances, which then would drive you to lead to recommend the exact right products. And then you've got 3 specific rules there. Take the income into account and the expenditure. Give consideration to that information when you're making that recommendation. And be comfortable with yourselves that if you are recommending a project that travels with a payment, that it is affordable and sustainable throughout the life of the loan. Fabulous. Then I will just finish in my last 2.5 minutes with our quick reveal in terms of we actually have been expanding. As I say, our Flexi Choice product is more for those people in the low to mid loan to value release space, but we have now brought to market our tailored interest reward. Again, like Flexi Choice, there are longer sessions so you can learn more about this product, but essentially, again, it's different and it's a product that's there for suiting individuals' needs again. So unlike the rigid 5, 10, 15 terms or our set term, even with Flexi Interest Reward, which can be variable, with this product, they can service up to 100% on their interest on a monthly basis, and they can do that for as long as they like. There's no set term. They can just actually decide on a month-by-month basis whether this is a plan that suits their needs. You can also, with a month's notice, take a payment holiday. So again, we talk about that. I want to take Christmas off. I want to take November and December and January off to pay for Christmas. They can do that with a month's notice. And if something happens that they can't give us notice, they can actually additionally also miss another 2 payments before the discount would end. You can take a drawdown from day one from this product as well. And those drawdowns do come with the facility to be either on an interest reward basis or not. And the entry level for servicing interest here is 25%. And you'll get a range of discounts depending on what product, which is based on what loan to value need is within that set. So what I would say is this is an Air exclusive. So if you are interested to see what these products look like, you can go onto sourcing. Please do use that box that says how much income you can afford to put towards a mortgage. And then you can take a drive around what the options are for your clients. We do have a ton of people back at Preston, as well as ourselves in the field. So if any of you want to discuss these further now or in the future, or attend any of those more detailed webinars on these products, then please do shout out and we'll make sure you get the invitations. With 32 seconds left to go, I will then just say thank you very much for your time and attention today. I hope you found it useful.